So number 8 is price by volume. We want to see those levels of support and resistance play through here as well. Number 9, here's a mathematical one that I love to do, the mathematical test. Channel width divided by average channel price. Let me explain. So it looks like on Caterpillar, we found a channel most recently somewhere around this $91 zone, where we saw it tested a couple times, and the $98 zone, okay? So the channel width of this 91 to 98, and we can also probably see that. Let's go back to our price by volume. Let's put a line here and see what it looks like, because a lot of times you can see things in a point and figure chart that you cannot see in your price by volume chart. So here's $91, and then let's put a line up at 98 and see if they correlate. So again, I probably wouldn't trade this until we popped back down into this zone, but there's a high likelihood that this will pop back down into the zone. In fact, it already looks like it's going, probably looks like it had its earnings. Earnings were popular, but I'm telling you, market forces will probably bring this back into this zone. And when it's back into this zone, it becomes a candidate for my 6% protocol again. Okay. Let's go back to our point and figure. Let's go back to my last tests here. And then we'll talk about how to turn the 6% protocol into a supercharged trading strategy. Channel width, average channel price. So 91 to 98. The channel width would equal $7. So the math behind that would be $98 minus $91. So that's the channel width. Does that make sense? How many with the show of hands you get how I calculated the width of the channel? How wide in dollars is the channel? How many with the show of hands, let me put your hands down, are a little bit confused? Good, not so many people are confused. So then let's talk about average channel price. The average channel price is 98 plus 91 divided by 2. So the average of that channel is 94.5. Anybody have questions about how I calculated the average channel price? You do, raise your hand. I'm just taking the high and the low of the channel and dividing by 2. That creates an average. So now I've got the channel width over average channel price. All right, and that's going to create for us a ratio or a percentage or a fraction. So let's do that math right now. So if I take my 7 and I divide that by 94.5, I get 7.4%. So the channel width divided by average channel price. And I'm just keeping my eye on the clock. I don't want to spend too much time on these, but these are amazing analysis methods for determining if something is worthwhile for trading these 6% protocol strategies. I go into like hours and hours of this type of analysis over and over so that folks who subscribe to the 6% protocol know what I'm talking about, but I just want to introduce it to you. 7.5%. 7.4%. Now, ideally, I would like to see this number to between 10 and 20%. When it starts to get smaller than 10%, I start to get the heebie-jeebies. And I don't know if that's a regional term, but that means I get a little bit uncertain. Okay. When it gets really small, below 5%, I won't even touch it. Makes sense? How many of the show of hands makes sense? This is going along with, I don't want something that is going to be tightening up too much, because when a channel starts to tighten up too much, it tends to head towards a breakout, which is not what I want to have happen while I'm doing this trading strategy. I'd rather have it just go nice and calmly for years sideways. The final test I want to give you is just check if they have dividends. Why? Because when a company gives out dividends, investors are less incented for the company to have asset appreciation. In other words, investors who get dividends are happy and with a stock that just goes sideways. They don't need to, they don't put pressure on the company either through, direct pressure or through buying and selling pressure to have their stock price appreciate. It's okay because they're getting their monthly dividends. They're making an income. So if you see that there's dividends on a particular symbol, then that gives you more confidence that it's okay, that it's going sideways. There's not going to be as much pressure on the company to have their stock price go up. Okay. Also, dividends are a nice benefit if you are actually doing covered call writing, because then you can also make money quarterly on owning the underlying symbol. All right. How many of the show of hands have these 10 tests down? Again, if you have any sort of questions about these tests, you can always follow up with me later, aj@tradingtrainer.com. But I want to move on here. I want to show you about now how we might trade this. Now, the traditional covered call would be that I'd go out and I'd buy a whole bunch of Caterpillar stock, and I'd have to buy it in lots of 100 because I need to have a matching number of options to sell against it. So we call that an instant dividend. We also call it a profit buffer, because basically what we're doing, if we pay, how much is Caterpillar going for right now? Caterpillar's going for $101.35. If we pay that much for the stock, then we can sell our call option as kind of a coupon against the stock and make an instant dividend. In other words, let's draw a picture here. When I buy a stock, if that stock goes up in price, I make profit. If that stock goes down in price, I can make a loss. By selling a covered call against it, I actually move the amount, the cost basis to the left by the amount that I make on the premium, how much I made by selling the covered call. So basically, I've just bought my stock at a discount. I made an instant dividend, and I've also given myself a profit buffer. If this thing goes down a certain amount, I'll be okay. Now, you can't get anything for free, and so what you wind up doing by making this decision is you wind up capping your profits at a certain level. Now, if we're dealing with a nice sideways moving stock, that's not a problem because the stock is moving sideways. So we're just going to be, if you will, we'll be, and you will, we'll be renting this stock out every month or every week, because now they have weekly options, right? And that's kind of the whole idea behind this. But I want better returns, right? Even with the 6% protocol screener, I'm going to have to, the screener's right now finding buy rights at somewhere between 1.5% and 4%. I need better returns than that if I'm trying to double my money every year. How many with the show of hands follow. So we need to figure out a way to lower our cost basis. And this is where we're going to come up with, we could play around with what's called synthetic equivalencies, but still, even with the margin requirement, that's a little bit on the high side. So let me give you kind of an understanding. Some of you with options experience already know this. But an option price, when you look at any price of an option, that price of an option has two components in. One is called the intrinsic value, and one is called the extrinsic value. Now, those are academic terms. The common name for extrinsic value is premium, or some people call it time value. I don't like that name because it's not just based on time, but you'll hear people talk about the time value of options or the premium of options. I like the name premium. I like the name extrinsic value. When you add these two values together, the intrinsic value and the premium, you get whatever the price of the option is, right? So the intrinsic value is the value of the option at expiration. It's when all of that emotional component, the hedging component of an option price is worn away. How many of you with show of hands have heard that an option is sometimes called a decaying asset? What decays away is the premium. The intrinsic value is what is left over. What's interesting is when you look at the option price on a graph, what you notice is that there is a point, a certain distance away from the strike price, where the premium decays away and all that's left is intrinsic value. Intrinsic value is the hard value of an option. It moves dollar for dollar with the symbol that it's on top of. So for instance, if Caterpillar goes up $1, the intrinsic value goes up $1. If we go with an option that's called in the money, in fact, if we go deep enough in the money, for you guys that have experience with options, you're looking for a delta of 1. For those of you that don't have experience with options, what we're doing is we're going deep enough in the money that this particular option is now acting one-dimensional. It doesn't have the components of time decay. It doesn't have the components of volatility adjustments because people have buying and selling pressures on it. We call it being at parity. All right. We also want to make sure that this thing is far enough out in time that we're not going to worry about expirations, and also putting it far enough out of time makes it so that the time component doesn't affect us as well. And so what we're going to do to substitute for that stock is we're going to find a far out in time, deep in the money call option that's going to be a fraction of the cost of the stock. We're actually going for, again, for you option folks out there, we're going to create a diagonal trade. For those of you that don't really care whether you're an option trader or not, we're basically going to do right calls against a far out in time, deep in the money leap